Hello friends, welcome to another episode of BayView Views. I'm Mark Dutram. I've always been a big proponent of having objective money management, and not only for, the people that we help every day, but for myself. I do have some play money because I think it's fun, but my serious money in marketable securities really is invested in the models that we manage. And I do this obviously because I believe in our investment philosophy, but I also do it because I believe in something called behavioral finance. This is so important, guys. Behavioral finance is the study of the psychological factors that really influence our financial decisions, and they're based on how we interpret and act on information. We can be our own worst enemies, as we know, and we have these kind of built-in biases that affect each one of us. And really, nobody's immune from the mental and emotional effects. And I'm going to share a few that I recognize not only myself, but I've also seen, happen in other people. And it's really fascinating. I studied a lot of this in my CPWA program. But what the research has shown is that there are many kind of mental shortcuts that we create when we're making complex decisions. And these shortcuts can bias our judgment and lead us to make some bad decisions, particularly with our money. So unless you learn about them, and they're kind of unconscious beliefs that influence how we make decisions, they can really hurt us in a harmful way. So I'm just going to share a handful with you that you might recognize again in yourself, and something that I again recognize in myself. The first one, and is probably appropriately timed, is called loss aversion. And what is it? So loss aversion is a bias toward avoiding losses over seeking gains. There's a lot of data that supports this, but studies have found that people feel the pain of losses twice as much as the pleasure of comparable gains. Now, again, and you might recognize that in yourself, this causes someone to act out of emotion, especially when markets are volatile, like they are today, and therefore they might have a propensity to buy high and sell low. So loss aversion also causes to avoid even, taking small risks, even when they're probably worth it. It might be why people either save rather than invest, even though that we know inflation, particularly today, will erode the value of our savings over time. The next one that we see quite a bit of is what we call herd behavior bias. And again, people will come in and tell us what their friends or plumbers are doing. But herd behavior happens when investors kind of follow others rather than making their own sound financial decisions based on facts or data. And for example, if all your friends suddenly are investing in penny stocks and of course making a ton of money, you might want to start buying them too, even though they're quite risky. So people follow the herd because they feel like it's safer. There's also kind of a fear of missing out, FOMO, right? If your friends say they're making money, for example, in like crypto, and it feels uncomfortable for you to sit on the sidelines where they're making all of this money. The next one is called anchoring bias, and we see this quite a bit. It's kind of a phenomenon where somebody values an initial piece of information too much to kind of make subsequent judgments. In investing, this can influence our decisions when we're making decisions about a position that we hold. Like, should I buy more of this stock, or should I, even sell it? And, again, since many investment decisions require kind of multiple complex judgments, we're all vulnerable to anchoring bias. For example, a person might hold on to a stock for much longer than they should have because they're anchored to, that higher price that they bought it for to begin with. Overconfidence bias. This one particularly affects me with my optimism, but overconfidence bias is a tendency to see ourselves as better than we are. And it's common, certainly, in investing. There's, again, a lot of data on this, but there was a 2020 review that was published in the, I think it was the International Journal of Management. But they found that overconfident individuals generally didn't manage their own money too well or control risk properly. The problem is that when we're overconfident, it can make us overestimate our abilities and our knowledge, which can lead to kind of rash or poor investment decision. Overconfidence can lead somebody to believe that they can accurately even time the markets, forecast the economy, predict where interest rates are going to go. Many things that we know, the economy is notoriously very unpredictable, right? Another one is called confirmation bias. Confirmation bias is our tendency to seek out information that really supports what our existing beliefs are. And obviously that can be a problem because we'll try to seek out and find supporting information that really justifies holding a particular position that we have already that might need to be replaced. And it goes really hand in hand with a bias called cognitive dissonance, which is a phenomenon that when we get information that conflicts with what we already believe, we actually feel a physical uncomfortableness about us. And you might have experienced that not only in stocks, but in politics and different worldviews that we have out there. So there are so many more biases, guys, just being aware of them. Hindsight bias, another one where people say, I knew that was going to happen. I could have told you that was going to happen. Recency bias, where we give too much weight and credibility to events that have happened recently in our decision-making process. So there are a couple actually also that can really hurt you. I've seen a few people fall prey to this. One is called the narrative fallacy. The other one is called a framing bias. And people, they can fall trapped to a good story or how a product is framed, more importantly than, the actual facts about what they're buying. And again, we see people fall into this. I guess that would be susceptible to a very good salesman, right? We'd like to think, that we make financial decisions around maximizing returns or minimizing risk. But the reality is that our decisions are influenced by so many different factors, including these biases that I've mentioned today and many, many more. And they affect our emotions, and we start, behaving off of our emotions, which is a very dangerous thing. You might have recognized some of these things in yourself, and you might have even fallen prey to some of their effects in your previous decision makings. And they can do that. They can lead us to make poor decisions. But again, the more that we're aware of these things, the more it helps us to avoid them. So as I said in the beginning, having an objective and a professional advisor, someone having, a knowledge of how these self-defeating biases can hurt you, having kind of a long-term financial plan or a goal to help guide you. These are all very important factors in helping us make sound financial decisions. So I hope you've enjoyed another episode of BayView Views. These are great concepts that we try to share with you guys to help you be better investors. If you have any questions about this episode or any others, please reach out. We'll be glad to help. And guys, we appreciate you. Have a great day, okay?